Right, let's jump straight into this explainer and unpack the massive Payday Super shakeup hitting Australian businesses in July 2026. For decades, we've all operated under a pretty predictable rhythm when it comes to employee superannuation. But if you run a business, manage payroll, or sit on a company board today, the rules of the game are changing fundamentally. You absolutely need to be prepared for the shockwaves this is going to send through your daily operations.
Now, to really understand what's at stake here, think about it. What actually happens to your business when the ATO starts demanding super payments every single pay cycle? Spoiler alert, it is not just an admin headache. On the surface, aligning super with payroll might just sound like, a minor software tweak. Actually, scratch that. It is a massive structural rewiring of your cash flow, your risk profile, and critically, your personal liability.
We are taking that old, comfortable 90-day quarterly buffer we've all gotten so used to and just throwing it out the window. From July 1st, 2026, every single time you run payroll, weekly, fortnightly, monthly, whatever, you instantly trigger a super obligation. That grace period to manage your cash flow is completely gone. And let's be totally honest with each other. For a lot of businesses, that 3-month delay wasn't just a deadline. It was essentially free working capital. Well, relying on that safety net is no longer an option. It all comes down to the Treasury Laws Amendment Act 2025, which radically shifts the ATO's visibility. We're moving away from retroactive reporting and stepping straight into an era of near real-time tracking through single-touch payroll. The exact second you hit process on your payroll, the ATO's clock starts ticking. They're going to know almost instantly if you've missed a payment, meaning the compliance window you used to have to quietly correct innocent mistakes is shrinking down to practically zero.
So the absolute magic number you need to burn into your brain right now is 7. 7 business days. Under the new rules, superannuation must physically land in the employee's fund within just 7 business days of payday. It's not enough to just process it on your end or fire it off to a clearinghouse on day 6. If there is a processing delay on the bank's end, guess what? That is still your compliance breach.
And if you miss that insanely tight window, the super guaranteed charge kicks in automatically. No leeway, no excuses. And it gets worse. Penalties can reach a staggering 50% of the unpaid amount for repeat noncompliance. Toss in an administration fee and a 10% compounding interest rate on top of that, and it's a terrifying compliance snowball effect. Oh, and if the ATO issues a formal notice to pay, you can't negotiate your way out of it. Those penalties are locked in. But look, the financial hit to the business is honestly only half the story here. The personal risk for company directors is going through the roof. Because if your business struggles and super slips, you instantly lose your Safe Harbor protections. Safe Harbor has always been that legal wall between company debts and a director's personal ruin during tough times, assuming you are reporting on time. Under Payday Super, if you miss that strict 7-day deadline, that shield drops immediately.
Because without that safe harbor, you are suddenly wide open to a director penalty notice, effectively tearing down the corporate veil and making you personally liable for the debt. This is a highly aggressive ATO mechanism. Imagine a small construction firm whose accounts run dry because a major client delays an invoice. Before, you had time to recover. Now, the ATO isn't just looking at the struggling company. They are looking directly at your personal bank account, your savings, and literally your family home. The stakes have never been higher.
So naturally, with personal assets sitting right on the firing line, you're probably thinking, okay, well, won't my management liability insurance just step in, pay the fine, and make this whole nightmare go away? It's a wildly common assumption across boardrooms that a robust corporate policy is just a catch-all safety net for this kind of regulatory mess.
The blunt reality? Absolutely not. No way. Your corporate insurance is not a get-out-of-jail-free card for ATO penalties. The policy will not pay the unpaid super debt, and it certainly won't pay the statutory fines. The employer owes that original money, period. It also will not cover the SGC penalties or that compounding 10% interest. And if they decide your noncompliance was deliberate, your coverage could be completely voided. What your insurance actually does, and this is a crucial distinction, is fund the fight, not the debt. It acts strictly as a safety net to absorb the heavy blows of litigation. It can cover the legal defense costs if the ATO pursues you personally, the exorbitant fees for contesting a DPN in court, or the cost of professional representation during an intensive ATO inquiry or insolvency investigation. But you need to be highly aware of the gray area here. While some policies do have extensions for statutory fines, whether they specifically cover SGC-related charges heavily depends on your exact policy wording. This is a massive variable. It could literally mean the difference between financial survival and ruin. You need to get on the phone with your broker tomorrow, not in July 2026, to review that fine print and make sure you actually have the coverage you think you do.
Okay, let's pivot to your daily operations for a second, because this shift is going to engineer a massive hidden cash flow shock. Imagine sitting on 40 grand in super over a quarter. Suddenly, under these new rules, you have to bleed out $6,150 every single fortnight. If you've been secretly relying on that quarterly super buffer to smooth out your working capital and pay suppliers during tight weeks, you need an entirely new cash strategy right away.
And if that wasn't enough, they're also changing the underlying math. The calculation base is shifting to qualifying earnings. Simply put, the bucket of what counts as earnings is getting bigger. It now catches salary sacrifices and payments to certain contractors, replacing the old ordinary time earnings standard. If your payroll software doesn't know the difference and you miscalculate this on a rushed 7-day turnaround, you underpay your staff and instantly trigger those exact 50% penalties we just talked about.
Oh, and just to add another operational hurdle, the ATO is permanently shutting down its small business clearinghouse on July 1, 2026. They are essentially evicting smaller employers from this free service. This forces everyone to go out, vet, select, and transition to a commercial, SuperStream-compliant alternative before the deadline. Just one more thing to do while you're overhauling your entire payroll process.
Then we get to the ultimate ripple effect, workers' compensation. Because super payments dictate your declared remuneration, a simple 7-day miscalculation triggers massive premium penalties and dangerous underinsurance in your workers' comp policies. And remember that near real-time reporting via single-touch payroll? It creates a highly visible paper trail. State insurers can and absolutely will use that data to audit you if your numbers don't perfectly line up.
Now, a tiny bit of good news. The ATO knows this is going to be chaotic. They've published PCG 2026/1 outlining a risk-based compliance approach for year one. They're categorizing employers as low, medium, or high risk based on their attempts to pay on time. Low-risk employers, the ones genuinely trying to comply and fixing errors fast, will get some breathing room. But be warned, this leniency is strictly temporary for year one. High-risk employers leaving shortfalls, you'll face the full, unforgiving brunt of enforcement from day one.
So how do we survive this? Well, hope is definitely not a strategy here. You must execute these 3 operational steps immediately. First, aggressively upgrade your payroll systems to handle qualifying earnings automatically. Second, model your cash flow completely without that quarterly buffer to find your weak points. And third, review your management liability coverage with your broker today to close any gaps.
I'm going to leave you with this final thought to take back to your management team as the clock ticks down. July 1, 2026 might feel like a while away, but in corporate time, it's practically tomorrow. There are no extensions on the horizon and absolutely no permanent grace periods for small businesses. Is your payroll ready to pay the price? Take the time right now to get your systems and safety nets firmly in place. Thanks for joining me on this explainer, and I'll see you next time as we break down more essential topics.